Not only is this another startup losing enormous amounts of money, $1.9 billion last year, but it is extremely complicated. Take a look at its corporate structure. This is a photo from the S1. 3 classes of stock, multiple levels here. Now, another thing that sticks out to me is what this prospectus does not include. Now, I was eager to get some numbers or color at least around occupancy rates, especially key to what might happen in a downturn. And this is one of the biggest questions WeWork is facing. We do not get that. Another key metric is average revenue per member. That is delivered to us in the prospectus on its own, $6,320. But there are no past numbers given telling investors what the trajectory has been. There is a note, however, a few pages later telling us that this number has declined, a trend that WeWork expects could continue in the near term. Now, guys, what the filing does tell us could be concerning to prospective investors. WeWork has long touted the growth of its enterprise members, which makes up about 40% of the total. They typically sign longer leases and lead to a larger committed backlog of revenue. Now, the proportion of these memberships has exploded over the last few years, but this year, the growth rate has ticked down. Moving on to another metric, contribution margin. Uber and Lyft, they use a similar metric to show unit economics, how they eventually reach profitability. In WeWork's case, this is membership and service revenue minus operating expenses and stock-based compensation. What you need to know, though, is that the growth rate of this metric has been flat or declining over the last 5 quarters. Lastly, guys, I'll just point out that expenses at WeWork more than quadrupled from 2016 to 2018. So some major questions about its path to profitability, the same thing that we look at for Uber and Lyft. So in short, guys, this is a prospectus that probably raises more questions than it answers. We'll continue to dig through it. Guys?
Yeah, it raises a ton of questions, Deirdre. Among them, and you touched on this a little bit, WeWork says that 70% of its markets are not mature, meaning they say that after 2 years in a given market, it tends to reach maturity, occupancy rates stabilize, cash flow stabilizes, their expenses and kind of ramping up and marketing the place stabilize. 70% not mature, so the fact that they don't give occupancy rates and such a huge majority of their markets it seems aren't mature and probably don't have great occupancy rates raises the question of, boy, what does happen when inevitably things slow down or we get a recession?
Absolutely, John. And the fact that we don't get occupancy rates, but we don't even get a breakout by region. So is Latin America faring a little better than China? We don't get any of that. There was another line far down in the prospectus saying that its China business, because it is still developing, probably took off 3 percentage points from that contribution margin. I'm wondering what's happening in other areas around the world. WeWork is operating in many, many different places. So, again, you touched on another point that I think the prospectus did not answer that investors are going to want to know.
Yeah. They also point out that they have a kind of complicated ownership structure or financial structure in which they have partial ownership in real estate investment vehicles that they also then do business with. So it could be that if those investments go south, even if it has nothing to do with WeWork's business, it could affect WeWork's finances. And then, of course, this is a controlled company also, so the amount of general governance that we're going to get in this company is also a question mark.
Yeah, it's a good point, John. And you touch kind of overall, this is Adam Neumann, the co-founder's role in all of this. There's a lot of unusual things relating to him, particularly what could become conflict of interest relating to ARC. That is the company that you're referring to that holds actual assets, property assets that then WeWork can lease from. There's some other parts about family members involved in the business. Adam Neumann pays a direct family member less than $200,000 to be the director of wellness at the company. So there's a lot of unusual, call them maybe quirks within this prospectus. Some could be glaring conflict of interest. Some other ones that, like I said, are a little bit smaller, but still raise questions as to what is Adam doing with the money, especially that he's taking out of the company. He has a line of credit for up to $500 million.